Hey, what's up, guys? Welcome to another episode of Tax Tip Tuesday. And this week we're going to talk about a topic called real estate professional status. And this is actually one of the most important parts of the tax benefits on the investment side of things. Okay, so we talk about all the time that there's all these amazing tax benefits of investing in real estate, especially with acquiring rental properties. But there are limitations on how you can take advantage of those benefits. I've mentioned this in several of the videos we've already done on all these crazy things like depreciation and cost segregation studies and all these things. And the reason that there are limitations is because of what they call the passive loss limitations. They consider real estate to be a passive activity. And because of that, if you make below $100,000, you can use up to $25,000 per year to offset your other income, like from your W-2. Once you start making over $100,000, that starts to get cut off. And once you make $150,000, it's gone completely. And that's total household income, right? It's not just you. So you and your spouse together, if you hit that 150 mark, you do not get to take any of the losses from those rental properties that they're almost always going to show on taxes. So in order to take advantage of almost all these topics we're going to talk about, to fully take advantage of them, you're going to have to qualify for real estate professional status. So let's dive in today, see exactly what that is, how you qualify, and what it will mean when you do. All right, so first let's look at the benefits of the real estate professional status. Like I said, the tax code has limitations on the losses that you can take from real estate activities in order to offset your other income. All right, so you have a high-paying W-2 job. In order to fully take advantage of those benefits or take advantage of all of those benefits of those losses, you have to have the real estate professional status. You don't have it, you have over $150,000, you will not get to take advantage of it. So the first huge benefit is you unlock all of those tax benefits regardless of your income. Second thing, there's something called the net investment tax. It's an additional 3.8% tax when you sell certain assets. And properties can be one of those. If you're a real estate professional if you have real estate professional status, you can potentially avoid those. And basically, to sum it all up, it unlocks all of these tax advantages. Everything we've talked about, everything we will talk about, they're all fully unlocked if you qualify for real estate professional status, regardless of what your other income is. All right, so now let's look at the important part. What are the rules? How do you actually qualify? Well, the first big test is that you must spend at least 750 hours on qualified real estate activities each year. And there's a whole summary of what is considered qualified real estate activities. If you just Google qualified real estate activities for real estate professional status, it'll come up. But if you have to have at least 750 hours there. The second big test, and this is one that a lot of people miss, is you have to spend more than 50% of your time on those qualified real estate activities. All right, so a lot of people say, okay, I have a full-time job, but I spend that 750 hours on my rental properties. No big deal, I qualify. Doesn't work that way. You have to spend more time on real estate than any other activity. So if you have a full-time job as a pharmacist, let's say, you have to spend more time on real estate than as a pharmacist. And generally, the IRS is not going to believe if you're spending 40 hours a week as a pharmacist that you're spending at least 41 hours a week every single week on your real estate activity. It's just not believable for someone to spend 80 plus hours a week working every single week. So generally speaking, and there's always exceptions to rules, but generally speaking, if you have a full-time job outside of real estate, you're not going to qualify because you're not going to meet this 50% rule. There's a way around that we'll discuss in a second. The third thing is you must materially participate in each activity. Just means you have to spend time in each of the activities, right? And the last thing is that you must document all this activity. The IRS isn't just going to take your word for it if they audit you and say, oh, did you spend that 750 hours? Yep, okay, you said so, we believe you. Nope, this is the IRS. They want documentation. It's very similar to like a mileage log when you're using your car for business. You need to have a real estate activity log where you're tracking all of those hours throughout the year, which I know is a huge pain, but it's going to protect you if you are ever audited. All right, here's the exception that I talked about. Here's how you can get around the 50% rule. Only one spouse needs to qualify. If one of you qualifies, your entire tax return gets the real estate professional status. Okay, so if you have your husband or your wife go get the real estate license, start doing some real estate activity, you have a super high paying job, you guys are both going to qualify for that point at that point as you're on your tax return, and you're going to be able to use all of those losses, regardless of if one of you have a super high paying job. So that's the workaround of the 750 hour or the 50% rule. You got to have one spouse that's meeting it. The other one does not have to. All right. So let's look at a brief example here. Let's say that Jenny is a physician making over $1 million in her day job. Right? She has a W-2 from the hospital she works at. She makes over $1 million. Her and her spouse, Ben, have 30 rental properties. Like most rental properties, they each show a loss for tax purposes. Right? Typically, rental properties, even highly cash flowing properties, for tax purposes show a loss. That's part of the tax benefits of real estate. But because their income, they're not able to take advantage of those losses until they sell the properties. They just keep rolling forward each year, and then when they do sell the properties, they can take advantage of those. But year to year, they cannot touch those losses. They're generating big losses on those 30 properties, probably $50,000, $60,000 a year or more. They cannot touch those because their gross income, their adjusted gross income is above $150,000. All right, but here's what they do. Ben goes and gets his real estate license. He begins working as a real estate agent. He also spends time working on the rental portfolio. He meets that 750-hour requirement. He doesn't have another job. He's just on the real estate side of things, so he easily meets the 50% test. And now all of those losses get to go against Jenny's W-2 income as a doctor. Okay, so that's the workaround. You have one spouse, go get the real estate professional status, and now all of those tax benefits are unlocked. And if they continue accumulating rental properties, they get 100, 200, 500 rental properties, they're starting to generate massive losses on their tax return, significantly offsetting Jenny's job as a physician. And they could potentially be in a situation, if they build it big enough, where they're wiping out all of her income. So she's a doctor making over $1 million a year, and they're paying no income taxes because they have all these rental properties and because one of them qualifies as a real estate professional. So it's a huge, huge, huge benefit. It's one of the most important things you can do if you are going to try to take advantage of the tax part of real estate. And look, tax advantages are just one small benefit of real estate. To me, they're almost sometimes overblown, but they can be a very big advantage. And in order to take advantage of it, you have to get that real estate professional status in most cases. All right, so conclusion, real estate offers a ton of tax advantages. Most people will not be able to take full advantage of them because of the passive loss limitation rules. But by having one spouse qualify as this real estate professional status, you can unlock all of those benefits regardless of what your income is. All right, so hopefully this was helpful. Again, in my opinion, this is the most important topic in all of real estate investing when it comes to the tax side of things. If you really want to take advantage of it, one of you have to qualify for real estate professional status. If this was helpful, subscribe to see all our future episodes, and we will see you next week.